In this presentation, we will be continuing on with our discussion of liquidity ratios. Remember that liquidity ratios are the largest class of ratios. We want to be able to group the ratios into classes for test questions as well as for use in practice so that we have a good idea of what those ratios are used for. Liquidity ratios are used to determine a debtor's ability to pay off current debt obligations without raising external capital. So are they able to pay off their debts? Are they a going concern? In other words, are they going to be staying in business going forward, given the fact that they are able to pay off their debt? In other words, if they're able to pay off their short-term debts, we're considering that they will be in business and remain in business and aren't in trouble of going out of business or having bankruptcy problems. Those are some of the questions that we'll be considering when considering the liquidity and efficiency type ratios. Now, other ratios will include solvency ratios. So we're going to have groupings of other ratios into solvency ratios, profitability ratios, and market prospect ratios. So notice here, we're continuing on with the liquidity ratios. We're going to be liquidity and efficiency ratios include the current ratio, the acid test ratio, the accounts receivable turnover, the total asset turnover, the inventory turnover, the days sales uncollected, and days sales in inventory. We will be concentrating here on the total asset turnover, the inventory turnover, the days sales uncollected, and the days sales in inventory. For prior types of calculations, you can take a look at the prior presentation. So we're looking at the total asset turnover first. The total asset turnover is going to be represented with the calculation or formula of net sales divided by average total assets. Total asset turnover measures a company's ability to use its assets to generate sales and reflects on operating efficiency. Total asset turnover is a bit more complicated of a calculation for most people when we're learning types of ratios, because again, it will be longer when you actually do the calculation, in part because the denominator has this average in it. We have the average assets. So if we analyze this ratio, let's think about this. We have the net sales. What is net sales? That's going to be an income statement account. It's going to be the top line, not the bottom line. In other words, not net income, net sales. The reason it's net is because if we have an income statement that's breaking out the detail in the sales, will have sales and contra sales like allowances and discounts, and therefore those are really contra sales and not expenses. So net sales is really basically the sales or revenue top line on the income statement. Income statement being a timing account, so this represents how we're doing over time, and we're comparing that sales, basically the goal of the company to generate revenue, to the average total assets. These are all the assets. We're taking a look at everything that the company owns as of a point in time. And remember, as of a point in time means on the financial statements as of the end of the year. And therefore, in order to line these two up into the significant or same kind of time period, what we want to think about is the average assets as they might be over any given point within the year. And therefore, we want to take the average, which will be the beginning year number in terms of what the total assets are at the beginning, plus what the total assets are at the end, and then divide by 2. As we consider this ratio, remember that the goal of the business isn't to generate assets necessarily, it's to generate revenue. The generation of revenue will often reflect in the generation of assets, accounts receivable, cash, but then those assets will be given back to the company for further generation of revenue, or they'll be given in terms of dividends. The goal is revenue generation. The assets that we retain, the assets that we're holding on to, what we're doing with those assets, the reason we have them is to help us do the goal to generate revenue in the future. If the assets, in other words, aren't helping us generate revenue, they shouldn't be in the company. We should be giving them to the owner. If we have excess assets, our goal isn't to just accumulate assets. If we have a lot of assets, typically the goal is to give those to the owner or reinvest them for the generation of future revenue. So this measure then is saying this is how we're performing. This is our net performance compared to the assets, the things we have, the tools, the resources we have to help us to generate that performance. So we want the top number to be as high as possible in relation to the bottom number. The higher, in other words, this ratio is, the better we're using the assets that we have in order to generate the revenue. That's going to be the idea. Calculation of this, we're going to have the information on the left-hand side. We have the two companies. We've got A and B, two sets of data so that we can compare it. Balance sheet information, income statement information, and prior year information. Remember that as we see this in a ratio format, we also want to consider how we're going to put this together in a table. And you really want to put these together in tables. If you just know a cheat sheet or if you've got this formula memorized in your head, not really good enough, because when you start to put this together in a test situation or under pressure, you really want to visualize how you're going to put this into a piece of paper. And you probably want to do as little in your head as possible and actually write down the steps, the actual calculations, because that'll help you to double check it if you have a problem, if you don't come to the answer that's on a multiple choice question or something like that. It'll also help you to show the work in the case you need to show the work. It'll also help you to think through this actual calculation to see what it means. So if any questions that come up that are saying, what does this mean, or what does this compare to that, you can go through it and say, oh, well, it'll give you some more insight as we actually look at the calculation. So I would recommend setting up a table, something like this, and remembering and memorizing anytime you see a total asset turnover calculation, how you're going to write it down. Visualize the grid. You can do that in Excel and then write it down on paper, or you can work with on paper, but just visualize how you're going to write it. I'm going to say net sales on top. I'm going to put that into the outer column. Remember that net sales is the income statement account. So we have the net sales for A and B. That's going to be the primary goal, the objective of the income statement, to generate revenue. We're comparing that to average total assets, which I'm going to put below with a colon, because I'm going to make that a subcategory. We're going to bring that into the inner column. We're going to have to do a separate calculation for the average total assets. It starts off with the beginning assets. Now, the beginning assets aren't on the balance sheet because the balance sheet is as of a point in time, as of the end of the time period. Where do we get the beginning numbers? From the prior year financial statements. Prior year total assets are going to be the current year's beginning balance. So we look for the prior year and we look for the total assets in the prior year, and that's going to be the number that we're picking up for both A and B. We're going to add that to the ending balance. The ending balance for total assets is, of course, on the current balance sheet because the balance sheet is as of the end of the time period. So that's going to be from the ending balance here for the total assets. We're going to add those two up. Why? Because we want to take the average of them to get the average time period over any point within the time frame that's being covered. In this case, the year's time period. So we divide by 2. That gives us the average. I'm pulling the average now out to the outer column so that now we can compare what this actual ratio is, which is the net sales divided by the average total assets. And then we get our numbers. And remember, you have to think about how many decimal points we're breaking this out to. So we got 780,000 divided by 450,370. We broke it out to 1 decimal, which is going to be the 1.7. So once again, think about what we're using here. This is going to be our total assets that we're dividing into the net sales. So this is the tools we have in order to achieve the performance that we want. And so we want this to be, the higher this number then, the better our performance is compared to the lesser amount of assets, the more efficiently we would be using the assets. So in this case, then B is looking better than A. Inventory turnover. So we'll take a look at the inventory turnover, which will be the cost of goods sold divided by the average inventory. As the name indicates, the inventory turnover measures how long a company holds inventory before selling it. So how long are we holding on to the inventory? So we typically want a higher inventory turnover because a company with a high turnover requires a smaller investment in inventory than one producing the same sales with lower turnover. Now, when we consider the inventory turnover, we have another type of calculation that's going to be a bit more confusing, in part because we have a balance sheet account and an income statement account. And the balance sheet account, like many of them, we're taking an average balance sheet account. When we consider the inventory turnover, we should intuitively think of these two accounts because inventory, of course, is an asset account. It is what it is. We know that that account's going to be there because we're talking about inventory turnover. The other side of inventory is cost of goods sold. And remember, that might not be quite as intuitive because when we think of the sales journal entry that has both a sales and an inventory component. When we make a sale, we debit the accounts receivable, we credit sales. And then the other side, the inventory side, is we reduce inventory with a credit and we debit cost of goods sold. So these two are related. They're part of the journal entry that we would consider when we make basically a sale. They're the expense of the inventory and the inventory assets going down. So we're going to be comparing those two with the inventory turnover. The top is going to be the cost of goods sold. That's going to be our income statement account, our timing account, the performance account. How are we doing over time? It's an expense. So we're talking about the expense of the inventory. We're going to divide that by the asset account. on the balance sheet, the asset account on the balance sheet, which as of a point in time, as of the end of the time period. In order to line these up, we want to take the average inventory, which will give us basically the average balance at any given point in time throughout the time period. And therefore, we take the beginning balance, add it to the ending balance, and then divide by 2. Let's take a look at an example. We have our information, balance sheet, income statement, prior year data, and we're going to take this information and visualize it once again in a table format. It's going to look a lot longer because the table format, we're going to calculate and show each of the line items, and I do recommend visualizing this as you practice. So we've got the cost of goods sold, top line item, that's on the income statement. Second line, first expense account, the biggest expense account, typically representing the expense related to us selling the inventory. Then we're going to have the average inventory, which I'm going to put a colon and a subtotal, bringing those into the inside, doing a calculation separately for them. We have the beginning inventory. Where's that going to come from? Not the balance sheet on the current year, because the inventory on the balance sheet in the current year is as of the end of the time period. We need to go to the prior year. We're looking for the prior year ending balance, because that's what the balance sheet is as of the end of the time period, which is the current year's beginning balance. That's why we have the added data here. We're going to add that to the ending balance for inventory, which is on the current balance sheet, because the current balance sheet is as of the end of the time period. We're going to add those two up. Why? Because we're doing an average. So we're going to add the two up and then divide by how many numbers we have, which are 2. And so we'll divide by 2. And that'll give us the 70,920. I'm going to pull that out into the outer column so that now we have our two components for the ratio, that being the cost of goods sold and the average inventory. Cost of goods sold divided by the average inventory. If we calculate that out, 592,100 divided by 70920, that gives us the 8.34. The 8.3, we're calculating it out to 1 decimal in this case. So let's think about this again. We've got the average inventory. This is the average inventory on hand at any given point, basically within the time period that we're talking about. We're dividing that into the expense of us basically selling the inventory. So this is representing us selling inventory. This is representing us how much inventory is currently on hand. And so if we divide this into the cost of goods sold, we're calculating how many times that average inventory is turning over. And we would like to have it turn over more generally, because that would mean that we're selling the inventory and not holding on to it as much. We would rather be selling our inventory faster and spending less time and effort and money and risk holding on to the inventory for a longer period of time. So in that case, then A is looking better at the 8.3 than B at the 5.2. Next, we'll take a look at the days sales uncollected. Days sales uncollected is going to be the accounts receivable net divided by net sales. We're going to take that and multiply it by the number of days in the year, 365. So once again, we have the accounts receivable net. That simply means that we're going to have the accounts receivable net of any allowance for doubtful accounts, the contra account that we think are going to be uncollectible receivables, or the estimated amount of uncollectible receivables. We're dividing that by net sales. Once again, net here does not mean net income. Top line sales revenue item is what we're talking about, but net of contra sales accounts such as allowances and discounts. So notice what we're comparing here. We have the days sales uncollected. So how long are the sales going to be uncollected? In other words, giving us an average of how long it takes for us to collect on the receivables. And as we consider this number, we of course want to consider it with regards to the terms that we have when we usually make a sale. In other words, how long do we usually give our customers to pay off a credit term? So if we make a sale on credit, do we expect to be paid within 30 days, 60 days, or what's going to be the standard? And then we can compare the day sales uncollected to those credit terms, and that'll give us a better idea as to whether it's a good or bad number. But mostly, generally, we want to get paid earlier rather than later because of the time value of money. As we consider this ratio, of course, we're thinking about the accounts receivable, that representing the account that people owe us money for, and we're comparing that to the related account to it, which is going to be the sales item. This is what we would expect, because this is the normal journal entry we would see. We would see when we make a sales type journal entry or something related to accounts receivable, we debit accounts receivable, recredit sales. Note, however, what might be a little bit unexpected compared to some of the prior ratios we have is that although we have an income statement account and a balance sheet account, we're not taking the average accounts receivable. We're taking the accounts receivable as it is at that point in time on the current financial statements as of the end of the time period, generally when calculating the day sales uncollectible number. Let's take a look at an example. Here's our data. Here's the balance sheet. Here's the income statement. We're going to be calculating first the current receivables. So the current receivables are the $34,400. Note, once again, not the average, but the receivables on the balance sheet of the current time period. And here they are, the $34,400. We're going to take that and divide it by the net sales. The net sales are going to be on the income statement. So here's our net sales. We're going to divide those out, and we're going to get the subtotal, in our case, of the 0.04. So we'll divide that out by 34400 divided by 780,000. And we always have to deal with the rounding. So remember that rounding is always going to be a factor. We'll take that and multiply it times the number of days in a year, this being 365, and that'll give us our 16.1 and our 21.3. Typically, we would want to get paid earlier rather than later, so the 16.1 for A will typically be better than B here. But note, again, this is going to be relative to the type of industry and the credit terms that we typically offer, because, of course, some businesses just by nature will have longer collection periods than others. But if we're looking at related types of businesses, we're looking at period to period, we would rather basically receive our receivables earlier, if nothing else, because of the time value of money and the reduced risk with getting the money earlier rather than later. We now have days sales in inventory, giving us an estimate of how long it takes for us to sell the inventory. And of course, we want to be able to sell the inventory generally sooner rather than later. That's going to be the general rule. We have the ending inventory. We're going to divide that by the cost of goods sold, and once again, multiply that by the number of days in a year, or 365. When we see the ratio such as this, we should consider and keep in mind, or have in our mind, that we're going to be dealing with these two accounts oftentimes because they're related within a journal entry. You can think of how are we going to record a journal entry related to inventory? Well, when we make a sale, we debit accounts receivable, we credit sales, and then we have the other side related to inventory, crediting inventory and debiting the related expense to it, cost of goods sold. So when we think about inventory and a ratio related to it, we're probably guessing it's going to have to do something with cost of goods sold and inventory. We're going to have the inventory on top. That's going to be the balance sheet account. Remember here, we're not taking the average inventory here. We're just taking the ending inventory, which is on the current financial statement, dividing that by the income statement account, the expense related to us selling the inventory, or cost of goods sold. We're going to take that number and multiply it by the number of days in the year, that being 365. Let's take a look at an example. We have the balance sheet, we have the income statement. We want to visualize how to format this information. We're going to start with a merchandise inventory, not taking the average, but simply the inventory on the balance sheet. That's going to be the ending balance on the balance sheet. Then we're going to have the cost of goods sold. That's going to be the income statement number, the timing number, the expense number. We're going to divide those two out to get to our subtotal here, which we're then going to multiply that by the days in a year. 84240 divided by the 592100, that's going to be the 0.142 times the 365. Note you're always going to have to deal with rounding here, so just be aware that we'll always have that kind of rounding issue. That's going to give us the 51.9 and the 78.6. Now, typically, we want to generally hold on to our inventory less, so the turnover that's going to be faster, in this case B, means that we're typically holding on to the inventory for less time period, generally a good thing.